In thinking about the next generation of non-traded REITs, I thought I would be able to uncover something magical, something elusive, the holy grail for non-traded REITs. But the more I think about it, the more I realize that the next generation of non-traded REITs is already here. And this is something that has been in the making. It's something evolutionary, not something radical, new and revolutionary. It has come about by paying special attention to common sense things that most of us would agree ought to be part and parcel of any robust investing program, which is really about putting client interests ahead of everything else. So in compiling a product design criteria that ought to be, at least in my opinion, integral to the next generation REIT, it should involve taking a long, hard look at things like valuations, suitability, liquidity, fees, life cycles, acquisition strategies, distribution coverage, leverage, and permissibility of affiliated transactions, amongst other things. Valuations. FINRA Rule 2340 governs how non-traded REITs are allowed to report their share values. It requires that such REITs use current estimated share value, not par value, not initial offering price, in their customers' account statements around 18 months after the close of the initial share offering. As a result of this change, many investors have been shocked to learn for the first time that the actual value of their shares in reality was far below what was being reflected in their account statements. Also, some REITs have paid a substantial portion of their dividends by issuing debt rather than from earnings. They have not updated their share valuations to reflect decreasing NAVs, giving an illusion of share price stability. So I think that the next generation REIT must accurately reflect the real value of the underlying real estate holding. Also, some REIT sponsors have artificially maintained share price stability. Since the shares don't trade, the price investors see on their statements every quarter doesn't change until it does. It is absolutely critical to have an independent valuation agent who objectively values each property on a frequent rolling basis. Someone who reviews trends in cap rates, in interest rates, in leasing rates, in vacancies to arrive at realistic NAVs. It is important to determine also whether a material event has occurred, an unexpected termination or renewal of a lease, a drastic change in vacancies, essentially anything that will have a big impact on estimated value. Another thing is, it is extremely important to amortize acquisition costs, expenses properly, make sure accruals and debt service costs are properly accounted for, and contracting frictions, fees, are reflected in arriving at valuations that reflect reality. So frequent, accurate valuations is absolutely critical for the next generation REIT. Issues for fee-based advisors. The illiquidity and lack of price transparency has kept non-traded REITs out of 401k plans. High selling commissions, upfront loads, these have dissuaded institutional investors. I think that the next generation REIT must bring in some degree of liquidity, provide better price transparency, have lower fees and commissions to make this attractive to institutional investors. And it is in the REIT's enlightened self-interest to do so for the industry as a whole, if the industry is to expand beyond the $10–12 billion annual size that it currently occupies. Enhanced liquidity. Non-traded REITs by their very definition are illiquid investments. As no public secondary market exists for their shares, investors are effectively unable to sell their shares even if the value of the REIT or its underlying assets decreases significantly. Illiquidity, however, can often be a good thing actually. Think about what happened in 2008 when investors irrationally rush for the door in a falling market. Illiquidity can shield them. Having a partial annual liquidity option can be even better. So next generation REITs enhance liquidity by expanding the amount of shares the REIT is willing to repurchase, as well as by holding more liquid assets. I think that properly designed, investors can participate in the repurchase program only after an initial holding period, typically a year, and if there are a large number of investors wanting to sell, the next generation REIT can reserve the right to limit the number of shares that can be sold. There is a relatively close relationship or correlation between listed public REITs and changes in the value of the general stock market. So this close correlation, one that has been increasing over the last few years, suggests that the value of shares of listed REITs may be based on a variety of factors beyond the value of the listed REIT's underlying real estate investment. So if one is thinking about investing in real estate, non-traded REITs might be a better way to get true exposure. Fees. It's important to have reasonable fees that are structured to align shareholder and sponsor interest. There are a number of fees in this space: selling commissions, dealer manager fee, acquisition fees, advisory fees, property management fees, ancillary service fees, internalization payments, public listing fees, incentive fees. All of this needs to be re-examined because fees greatly impact shareholder and portfolio performance. Knowing how and when these fees get paid is important. Knowing which fees are fair, which fees are unfair is important. So next generation REITs align fee structure with sponsor performance, often subordinating the payment of asset management fees in cash to distribution coverage, or having sponsors take their fees in stock, the value of which is realized only after shareholders have received threshold returns and a return of their capital. Now this promotes a further alignment of manager and shareholder interests. Finite life programs or infinite life programs. I think that infinite life structures where sponsors sit on properties and make management fees are a thing of the past. The next generation REIT ought to be finite life, with a clear focus on raising capital, investing capital, and harvesting it, and creating absolute total returns for investors over a 5 to 7 year period, if not sooner. Also, large $3 billion plus offerings have very few natural buyers on exit, and they create a perverse incentive on the part of the sponsor to live off management fees. Therefore, offerings should be small size, typically between $1.5 to $2 billion generally. Acquisition strategy. Public markets prefer REITs with a focused strategy rather than a diversified strategy generally. In general, all focused strategies tend to trade at a premium to NAV. Of course, there are exceptions, but in general. Diversified strategies in general tend to trade at a discount. Also, focused acquisition strategies signal disciplined effort. So we can see that being all things to all people, investing across all sub-property types is something that public markets frown upon. Doing office, malls, shopping centers, industrial, storage, triple net, healthcare, everything within one bundle, that's really not the right way to go. There are much cheaper ways to replicate the NCREIF index. What is needed in the next generation REIT is sector focus, for which there are natural buyers while exiting, and which public markets reward by way of a premium. Distributions. Some non-traded REITs do not generate enough recurring cash flow to fund their dividends and are forced to borrow or issue additional equity. So in these cases, leverage, not earnings, have funded dividends. This needs to stop in the next generation REIT. It is important for an investor to understand the what and how of cash distributions and a REIT's ability to sustain its cash distributions on a long-term basis. Distributions, once a REIT is raised and deployed, should come from earnings, not from debt or new equity capital raised. I think this is a very important criteria, one that has been overlooked in developing the next generation REIT. Leverage. Leverage, as we know, has the ability to both exacerbate returns and losses. The good news is non-traded REITs have generally done a very good job, much better than their public peers, in managing their balance sheets. Low leverage has been a way of life for the vast majority of non-traded REITs. And that was good because very few of them were forced into value-destroying capital allocation decisions, taking on expensive debt when they shouldn't have, selling properties on the cheap when they shouldn't have, or issuing equity on a NAV dilutive basis. The next generation REIT needs to incorporate explicit parameters on how much and what type of financing ought to be used to acquire property. Affiliated transactions. This is an absolute no-no. A non-traded REIT is typically serviced by a sponsor, an advisor, a property manager, and a dealer manager, and sometimes they may be affiliated, which creates conflicts. A sponsor is the person that organizes and controls the underlying properties. A property manager is responsible for leasing and maintenance. The advisor makes investing and disposition decisions. The dealer manager is responsible for selling the shares to investors. So this commonality of key individuals and entities in multiple aspects of a REIT's business can lead to substantial conflicts of interest. Example, when a REIT uses a credit line of one REIT to finance the operations of another affiliated REIT, or when a sponsor artificially increases asset turnover to maximize compensation, or when an advisor overallocates or underallocates performing assets at the expense or at the favor of others, or when a manager uses his or her knowledge to benefit other unrelated investments. So it is extremely important for the next generation REIT to have strong governance mechanisms and have explicit prohibitions from affiliated transactions that may ultimately harm investors.